You're listening to Fund Flow, a podcast for emerging managers offering insights into the journey of new and aspiring fund managers seeking to have access in a crowded market. Tune in as McGuire-Woods partner and host, Jon Finger, is joined by guests ranging from first-time fund managers to proven emerging managers, experienced LPs poised to back emerging managers, and other key participants in the emerging manager ecosystem. Hear their real-world perspectives and gain actionable tips to help inform your strategy and position yourself for a successful fund closing.
Welcome to Fund Flow, a McGuire-Woods podcast for emerging managers. I'm Jon Finger, and today we have Peter Eschmann, Managing Partner, and Liz Veilleux, Senior Vice President and Head of Capital Formation and Investor Relations for ACME Credit Partners. ACME Credit Partners is an SEC-registered investment advisor that delivers bespoke financing solutions to lower middle market companies to support acquisition, growth initiatives, transitions, and other mandates. Welcome, Peter and Liz. Thanks so much for joining me today.
Thank you for having us.
Great. Thanks for having us.
Absolutely. I always like to start and appreciate having both of you on this. Would be great to learn more about your path. Maybe give us some insights on each of your respective careers to date, and then ultimately what in your past led you to form ACME Credit Partners.
Sure. Liz, you want to go first?
Sure. I began my career at a private equity firm before transitioning over to public equities and public credit at Acadian Asset Management and Wellington Management. Overall, I find private markets investing really interesting and an increasingly attractive asset class. I'm personally invested in this asset class, and I was introduced to Peter and our other managing partner, Jay Rogers, through a mutual friend. I think ACME is well positioned for growth, and I'm eager to contribute to facilitating that growth and happy to be part of the team.
Great. So my background is I've been in lending since I got out of grad school. I was at JP Morgan, then went to Deutsche Bank, and I spent the bulk of my career at Cerberus Capital Management and their direct lending group. That's where I met co-founder Jay Rogers, and really was kind of the genesis for forming ACME Credit Partners. So we saw a opportunity specifically in the lower middle market direct lending segment, which is, we'll go into more detail, but we think is underserved and not as competitive and is an attractive risk return strategy.
Absolutely. Thanks for that. It's interesting having seen evolution is the wrong word, but how things ebb and flow as it relates to loans, right? Whether it's banks, non-bank, et cetera. But I guess what I'd love to learn more about is how do you feel like you differentiate ACME from other firms in the credit market? Maybe in particular, kind of non-bank lenders. How do you think about your unique value proposition?
Sure. So flipping the script, 25 years ago, right, banks were about 90% of the lending market. Today, they're probably about 10%. And the non-bank lenders have grown and have kind of taken that role on, right? So how we have thought about the market and what we focus on is we saw this phenomenon coming back after the great financial crisis and kind of the fund structures changing, but you really had a lot of new participants in private credit, a lot of them with a drawdown structure. And what that has done is folks have been very successful fundraising and they've raised larger funds. And what we believe is as these funds have grown into these mega funds of several billions and above, they have moved up market to focus on larger companies, putting larger check sizes to work. And what that has created is basically less competition in that lower middle market, and specifically around the non-sponsor side. The sponsor sides always have a following with banks and whatnot, but specifically that non-sponsor we find is less competitive, where we can still get attractive rates, and more importantly, the structures that we want, the protections, et cetera. We can get that in this market, right, where it's less competitive, so we do not have to give up as much on structural considerations as we were in the kind of the broadly syndicated market or the upper middle market.
And how do you, as you think about your competitors, how do you try to differentiate yourselves from that? Set aside the banks, from other non-bank lenders. What do you think what is it that sets you apart?
Well, I would say what we do is kind of speed to execution, right? We're a smaller fund, we're more nimble. We tend to look at a lot of transactions. And what we try to do is deals that we like, deals that we feel meet certain parameters. We try to exercise on that quickly, right? We'll give you an answer, yes or no. We'll give you a term sheet. And a term sheet is one that we'll close on, right? Go through diligence, et cetera. But we don't change terms. We deliver on what we promise, and I think that's kind of a big thing. But the other part, how we differentiate is it's really kind of the target market. There's not a lot of guys that are writing check sizes that we do per se, but those that are, we are doing in the sponsor market to a degree, but we're focusing on kind of that sort of complex situational kind of credit opportunity segment of the market, which is less traveled than kind of some of our other peers. And it's that part of the market, what we're targeting, et cetera, that we feel is just not as competitive, and kind of where we're able to kind of be competitive and find deals. And since we have closed back in September of 23, we haven't had any shortage of finding new opportunities. It's really just trying to hone in on those that are the best opportunities.
For sure. You alluded to this, so it's a good segue. Obviously, you and the team have broad and impressive experience in credit generally. Would love to learn more about how you feel like those experiences helped shape what you're building at ACME.
Sure. So I think Jay and I's career, like I said, I think I spent 16 years at Cerberus. Jay spent 7 years at Cerberus. He then left and became chief credit officer for a fund up in Toronto. But what I would say is that a lot of our experience are rooted in it's kind of a well-rounded. We follow a model we call our cradle to grave approach, right? Which is if you originate a loan, you follow that through to realization, whether it has any hiccups, if it goes through a workout, et cetera, you're still the same. It's the same team doing that. And that's kind of how we were brought up. So I think between the two of us, we have a lot of experience with underwriting deals, originating deals, structuring deals, but also on the portfolio management side, which we feel is a big part of our market that is maybe not as our competitors don't put as much attention on as we do. And that is really kind of where we have a lot of experience doing workouts, and whatever that may be, we've just been doing it for a long time. And that kind of that knowledge is we bring that knowledge with us.
Absolutely. Maybe touching a little bit, you alluded to your co-founder. Let's talk a little bit about the team. I appreciate the cradle to grave aspect of it, where things aren't being handed off from one to the next. But maybe tell the listeners, as you thought forward as an emerging manager, talk a little bit about the construction of the team there.
Sure. Our team structure is we work in small groups. Again, we want to be nimble. We want to be able to make decisions quickly. We have weekly meetings where we all sit, talk about new opportunities as well as our portfolio. Liz and her team also sit in on those calls. And the point of all of that is that we want everybody in the organization to be aware of what's going on with investments. And so typically how we structure this thing, it's a small deal term, right? A deal team, right? So each deal has a senior partner, which at this point in time is Jay or myself, and then we have a VP. And it's basically a two-person team that we manage the credit from origination, issuing the term sheet, all the way through the deal pays off. And again, that gets back to kind of accountability, and it's done for a reason, right? What we do not want, even as we grow and then more people to the team, but what would never will be is we want a team that's going to be accountable, right? So we're not looking to bring an originator in for them to be paid based on bringing AUM in and then handing it off and having it be somebody else's concern, right? We want somebody who is going to have good credit experience, that can underwrite a deal, originate a deal, and then ride it all the way through portfolio management. We think that leads to better overall returns, lower loan losses, and ultimately a better outcome for investors.
And with a relatively lean, focused team there, maybe talk to the listeners a bit about how you evaluate potential opportunities. What's important to you? I know you mentioned non-sponsor, but what are some of the hallmarks that you look for in a given potential opportunity?
So, given that we are a small team, we rely heavily on third-party diligence. And I would say in the vast majority of our deals, that's going to equate to getting quality of earnings, looking at audited statements, industry reports, asset appraisals, et cetera. We rely heavily on that and those type of third parties to do our diligence because we are such a lean team. But when we're looking at a deal, we have certain parameters. Our current portfolio right now is we're not that overly levered. I think our average leverage on our portfolio is under 3 times. But typically, everything we're doing is a senior secured, right? So first lien, second lien. So it needs to sort of fit within that box. When we're doing our underwriting, we typically are looking at right off the bat kind of what's the downside here and kind of what's our worst case scenario and kind of what is our workout scenario. How can we exit a loan? So we're typically doing 2 types of transactions: cash flow lending based off of the enterprise value, and or we're doing kind of turnaround deals in which we're looking at the underlying assets. If the turnaround doesn't work, can I get out? Can I sell a division? Can I liquidate the assets, et cetera? Just a different way to approach some of these transactions. So we're really looking at kind of the gamut in terms of underwriting the assets, underwriting the company, going through all the analysis that typically you would do with the industry, et cetera. We do focus a lot on the lower middle market. So, I mean, we're not dealing with people who are top 3 in kind of their industry. These are smaller companies that are typically an operating experience of at least 5 years, generating revenue of north of 50 million and generating positive operating income. And so that's typically kind of the environment, all North American based. And again, we're industry agnostic, so we'll look at kind of everything. It's more of a situation, customer loss, customer concentration, whatever it may be. And we try to structure up front, box in that risk, get comfortable with it, and do the deal that way.
And with the Cerberus in the background for each of you, maybe elaborate a bit on the importance and impact of deal structuring playing in the lower middle market and maybe how it's different than some of the things you may have done in the past.
I'd say the biggest difference is the size of the company you're with and kind of the sophistication of the borrowers, right? So a lot of these folks, these firms, they don't have a very well built out financial team, right? So you're typically dealing with a CFO, maybe it's a controller and kind of a CEO type of thing. So the level of sophistication is not necessarily there as you would see in kind of a $50 million EBITDA business. And so what does that do for you and kind of how do you have to approach that? Structure is the answer, right? I mean, like I said, we're doing typically these senior secured deals. They have multiple covenants, 3 or 4 financial covenants. There's also very big affirmative covenants. We're very big on reporting. We want to see, monthly, quarterly, annual budgets and the like. And kind of how do you do that, right? So we spend a lot of time on the portfolio management side, and I think this is kind of it's a benefit to some of the borrowers in that we are talking to our companies weekly, biweekly, et cetera. And you're establishing a relationship. We're following the financials. We're understanding where they are in the industry, et cetera, and engaging progress. But what I think that also helps these CFOs do, though, is kind of understand how a bank or these private credit lenders are looking, the type of information they want. And that gets them a little bit more regimented too, right? So maybe their reporting isn't what it should be. We believe kind of, you get into these cadence of how we report and what we're looking for, et cetera. I think that they can kind of manage the business a little bit better that way. So, I mean, I think the relationship's kind of beneficial in both ways.
Absolutely. And recognizing relatively industry agnostic as you think about your sweet spot for your borrowers, over the years, how have you seen the landscape evolve in the lower middle market with these borrowers?
Typically, when you're dealing with this size of the market, right? I mean, companies that are successful, there's companies that are not going to be successful, right? The ones that are typically growing through acquisition, through growth, get acquired. A lot of them, are become hit that size, right, for a private equity firm to become attractive for them. Other ones just won't work, right, and go out of business, whatever it will be. What I will say, though, is that there's been less people who have focused on that, right? I mean, everybody likes doing sponsor deals, right, because it's repeat business, right? I'll do one deal, two deals, three deals, and we're the same way, right, with a sponsor. But on the non-sponsored side, sourcing these transactions are difficult. It's time consuming. They take longer to close. But we think at the end of the day, you can get a better return, better structure, et cetera. That's why we pursue them. I would say that in terms of competition, though, it takes the same amount of time to underwrite a $10 million check as it does 50, 100, et cetera.
Sure.
And so I think people have tended to try to move up market, write bigger checks, et cetera. And so right now we're competing with banks who I think are, depending on kind of where they are in the economic cycle, regulations, et cetera, tend to ebb and flow in this market. So competition kind of goes up and down, et cetera, where you see it. But I mean, this is in my opinion, it's a very big, it's a very vast market. And it's quite frankly, it's underserved. So I mean, I'm not really too concerned with more competition in there. I think at the end of the day, people are going to vote with, as you raise a bigger fund, you're going to need to write bigger checks. So as long as you can stay disciplined, I think this is going to be an attractive market for a long period of time.
Great to hear. So one last, probably two-part question around the core of your business in the credit side of the equation. I guess part A, if you wouldn't mind sharing with the listeners the impact of interest rates, right? The Fed funds rate, how high it's been for an extended period of time, where it appears we're headed next month and beyond. Not asking for you to weigh in on where it appears we're headed, but surmising that the funds rate is coming down, what that means for both your business and your borrowers. And then I guess part B, talk to us a little bit about what you see out there, softness, any issues with the consumer side of things, maybe just talking more generally about what you're seeing from your borrowers and their respective businesses.
Well, I would say a higher interest rate environment is kind of where we are today is probably not good for the long term. I don't think that's controversial. I think a lot of people will say that, right? Do we benefit from SOFR being 5.5%, 5%? Sure, right? But I think long term, borrowers can only withstand so much, right? Firms can alter when they have inflation, cost inflation, goods, et cetera. They can offset that to a degree, raising prices, cutting SG&A, whatever it may be, restructuring the business a little bit. But if you have your interest rate costs tripled in a matter of a year, how long can you sustain that for? I personally believe not very long. I think we're into this about a year or so. I'm not sure how much longer companies are going to be able to withstand that, right? So what do they start to do? They start cutting some of the longer term prospects, whether it's marketing, CapEx, whatever it may be. There's a real effect to the business the longer interest rates stay this high. I'm of the opinion if rates were to come back down, 2 points on SOFR, that's going to be much better for the economy, much better for these companies, right? I think the longer they stay where they are, you're going to start to see more and more distress in the market. And I think the second part of the question, what we're seeing, we are sort of seeing that, right? You're seeing bankruptcies have escalated. Default rates are ticking up. Companies are running out of liquidity, and what do they have to do? I think we're seeing a fair amount of transactions that, quite frankly, don't make a whole lot of sense. I think people are kind of putting up that last-ditch effort to sort of see if they can get it done. Hire a banker, go see if you can kind of get this refinanced. But even at these levels, it doesn't make a lot of sense. So I tend to think that if things don't change in the near term, we're just going to see a lot more financial distress in the system. Distress can be good for us. We like some level of stress in the system, et cetera. It creates opportunities. But you going back to 08, 09, when you had the financial crisis, obviously that was too far, right? And that's not something we were looking for. Something in between is kind of what makes our business work.
Good old Goldilocks, right?
Sure.
That's super helpful. I appreciate your insights on that. So maybe turning the corner here a bit and talking about your fundraise, I guess as you set off on the fundraise journey, looking back to the beginning, what were some of your highest priorities beyond getting the fund closed? But as you set out on the journey, what were the things that you and your co-founder prioritized?
I'll answer this and I'll invite Liz to sort of comment as well. Basically, we wanted to, understanding that fundraising is never easy, fundraising for a first time fund, even less so. I think what we have seen over the past year or two is that even that success rate has gone down. The fundraising has been very difficult. How we've been approaching that, we basically have our strategy, right? We've been trying to be very clear on what our target market is. We do believe that this niche market is attractive. We do believe that the risk return parameter for a long period of time or the long term, we think is going to be very attractive for investors. Returning capital on a quarterly basis, getting to some of the events that we have seen around the longer hold times for LPs because they're not getting distributions back from whatever strategy. We think all that plays very well for private credit, and that's what we're targeting. But I think what we wanted to do, and I think Liz was a big part of this, is to sort of develop a team, not just for today, but for how this thing can succeed and make sure that we did our first close back in September with a group of investors. But how can we really grow the business? But how can we also structure it to make it more of that institutional feel that those type of investors are going to be comfortable coming in and investing alongside of us? That's why we registered with the SEC. That's why we audited our books for 23, even though we were in existence for a few months. We're trying to do all these things, not necessarily for today, but to sort of set us up for success down the road. And I'll hand it off to Liz, but she's been a big part of that, of kind of how do we really regroup and design the fundraising aspect to sort of succeed.
Thanks, Peter. So I guess just to add on to that, I would say having strong relationships is really important. And that's something we will continue over the years to continue to work with our current investors, potential new investors. And Peter, Jay, and I have been in this industry for over 20 years. So clients that we've worked with in the past that have approached us about investing into our fund, I think it's really important to have your due diligence set ahead of time. So within our data room, to have legal compliance, operational structures already in place is really important as we build a strong track record. So those are things that we worked on over this past year that I think will really set us up for success for the rest of 2024 and beyond.
Excellent. So as you look back on a successful fundraise, what were this is a question I always love to explore and probably gets some of the best answers for our listeners. What are some of the biggest challenges that you faced, whether it was strategy, whether it was being first-time fund? What were some of those challenges you faced throughout the fundraise process?
Well, I guess twofold. Personally, Jay and I have been on the investing side most of our careers, right? We lacked that kind of fundraising side, right? So it was developing that part, which has been a big learning curve, one that we've been happy to sort of take on, et cetera. But you need to, so it's wearing multiple hats, right? That it's doing the deals, and then obviously it's on the operational side, right? And it's finding the team to put in place that's going to be able to handle and do all of that, right? And part of that is, quite frankly, is finding the right third-party partners to do that. So I think early on we spent a fair amount of time, going through and putting the infrastructure in place to sort of do that. Second, it's team building, right? Having Liz in place, our investment team in place, and then kind of coming back to the kind of fundraising. It's been the type of investors. So we did our first close with 3 very successful family offices, and they've been very helpful, and it's been good to work with them. So now we need to understand kind of to sort of broaden that outreach, right? And that's what Liz's main goal is. But to really broaden the scope, fine-tune kind of our pitch and our focus, and kind of attract more investors coming in.
Did you want to add any? Sorry, Liz, I didn't know if you wanted to add anything there.
No, I agree with everything that Peter just said. And I think through some emerging manager programs, there's a lot of ways that we can raise our brand awareness and bring in more clients into the fund. I would say one other challenge that we have seen is that some LPs that were heavily allocated to private equity have been experiencing prolonged M&A slowdowns due to the higher interest rates, which was affecting their distribution timelines. So that, I guess, would be one other challenge.
For better or for worse, nothing that you could do about that. So
Right.
there you go. Did you use a placement agent or no?
We had initially we had used a placement agent on an interim basis, and then decided to bring that function in house with hiring Liz.
Got it. So as you look back, for both of you, I guess what advice would you give to other emerging managers out there looking to raise their first fund, private credit, strategy agnostic wise? What advice would you give other emerging managers?
I guess I'll go first. What I would say is that it takes a while. It takes a long time. I think where we've been at this for a long time. I don't think we're close to being finished. It's a long process, right? And you have to have the right team in place, and it's not easy, right? First time fund, everybody knows it's not easy, but it can be really difficult, and persevere through it. Yeah, that's what I would say.
I would maybe add on to that crafting a compelling pitch and clearly being able to articulate what sets you apart from other managers in your space is really important. And also networking within the industry and talking to other managers that are maybe a year or two ahead of you can be really helpful, just to hear what's worked for them or what hasn't. And especially within your particular asset class can be really important and maybe save you a lot of time. And then lastly, just prepare for due diligence so that when you get to that point with a potential LP or investor, that you're ready and that you have everything set to bring them on board.
Great insights there. Well, Liz, Peter, thank you so much for joining me today on Fund Flow, sharing your insights both on the fundraise and then also your day-to-day business. And thank you to our listeners for joining us on this latest episode of Fund Flow. We hope you join us again next time.
Thank you so much for having us.
Thank you.
Thank you for joining us on this episode of Fund Flow. To learn more about today's discussion, please email host Jon Finger at jfinger@mcguirewoods.com. We look forward to hearing from you. This series was recorded and is being made available by McGuire Woods for informational purposes only. By accessing this series, you acknowledge that McGuire Woods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this installment. The views, information, or opinions expressed are solely those of the individuals involved and do not necessarily reflect those of McGuire Woods. This series should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.